Hey, what's up, everybody? This is Dan Wynn with the Intentional Entrepreneur Podcast. I have a very special guest with me today. He is a certified, I can't believe CPA just escapes me, but he is a CPA. He did graduate. He graduated from with a degree in accounting and finance from Cal State Fullerton, and in addition to working with small businesses and real estate investors, he spent most of his 7 years tax career solving very complex tax issues for their multi-state and foreign clients. When he's not nerding out on case law, he loves video games and watching Star Trek and building computers. And a little known fact about him is that he played the oboe at the Performing Arts School. So I want to welcome to the show Joseph Daron, CPA.
Thanks, Dan. Thanks for the introduction, and glad to be here. Excited to be here.
Thank you so much for being on the show. Right now, we're recording this in December, and we caught him right before it gets pretty crazy. So I want to thank you again for just squeezing us in there. And I know you, we've kind of have a relationship for a couple years now, and you are like my go-to for real estate and taxes, and you've carved out this really great niche for yourself into the marketplace. And you got some awesome tips for our real estate investor listeners. But before we get into the fun stuff, can you share a little bit about your background and how you got to where you are today?
Yeah. So from a very young age, my mother was actually a CPA. So I've always known the industry, and so I went to college with the idea of going for my certification in CPA. So I went to Cal State Fullerton, a great little local college here, and I got my degree in business and accounting and finance. And then I went to go work for a local firm here called Keystone CPA, and I worked there for a number of years. And their niche was real estate, and that's how I got in this real estate niche. We After that, we started our own firm a few years ago, right before the pandemic hit, and it's been going off since then. So I've always had taxes in my blood. I've always had accounting in my blood, and I really found this real estate niche, and it's served a lot of clients very well. And a lot of people are always interested in real estate, and they don't realize all of the tax deductions and all of the great tax incentives there are there for real estate.
Absolutely. I know with, you know, most people think real estate as a way to build wealth, which is of course it is. But once they kind of get into the nitty gritty of it, and we'll talk a little bit about how it is as a business, then they'll find out, hey, there's this kind of other side on the accounting side and tax side where, like, hey, I'm gonna need someone else to help me go through this stuff and explain the stuff. Cal State Fullerton, fantastic school. I've got a lot of friends who went through the business program as well. That are my cousin actually, he went through the MBA program and is a CPA, and then one of my friends is graduated there and is also CPA. So great school, great business school to have get the degree from. Now, how was it? How was it opening your own practice through at the beginning of the pandemic?
Yeah, we actually started about 2 months before it hit. So it was an experience. It was definitely something where, I've gone to school to learn about how to start a business, and I've learned about entrepreneurship and all of these things in the classroom. And then, I worked at a small firm, so we were intimately involved with, it was a small firm, so um, I kind of knew the business side. And then once the pandemic hit, I'm like, wow, everything changed. All of the rules are out the window. Everything's changing. The entire world is, now in a bubble. So it was definitely challenging. We were lucky though because we had always wanted to be an online firm, so we
Mm,
have clients from all over the country already. I always say you can do taxes from the comfort of your living room or your home office at 2 in the morning if you like. So we
mhm.
were geared for that already, but it was definitely hard to try and get the traditional networking out there. I've
Right.
always known, you go to your chamber of commerce, you go out there and you go out and meet people and you do all these things, and all of a sudden all those doors shut. So it became a real challenge, and I think the thing that really helped us out was client referrals and business referrals. That's the thing that really kind of helped us get our business off the ground. It was just word of mouth, and once people tried our services, they were really happy with it, and they started going to other people. So that's what's really helped us out.
Okay, so is it safe to say way beyond majority of your business is really by referrals.
Yes. Oh, the vast majority of it is by referrals, whether it's from other professionals and other colleagues or from clients. We absolutely love client referrals. Whenever someone can think of us, I know taxes are never a fun thing, but when someone mentions taxes and then they mention us, it's the biggest compliment we could receive. So we're very grateful for that.
Yeah, yeah, and so one thing I'm very similar. Like 90% of my clientele is by referral, and thanks to great partners like yourself, where quality people come by and are looking for our help. And what we found is referrals. You know, um, they tend to be the better type of clients. They tend to not negotiate our fees, and they tend to kind of hire us more repeatedly than kind of the people who walk through the front door. So absolutely, referrals um, really essential part of obviously both of our businesses, and so thank you to everyone else who supported our businesses to keep our doors open. So yeah, now so let's kind of get into the nitty gritty here, and I know again you and your team have carved off like a very good niche in real estate investors. And so we're at the end of 2020 today. And, obviously, the kind of the primary residence market is kind of going through the roof, and kind of tangential to that too is the investor market. More and more people are buying rental properties these days. And so I wanted to have you on the show and discuss about some of the maybe most common missed tax deductions, or things maybe new or even experienced investors aren't really seeing that they can really take advantage of and really maximize their real estate portfolio.
Yeah, there are a ton of things out there, especially for real estate. I think one of the most powerful deductions out there that I've seen some people miss is definitely depreciation. So whenever you buy a property, you have this big asset. You have this property. It's worth a lot of money usually. So you actually get to depreciate that, or basically take a certain amount of expenses for that every single year. And even some generalist preparers we've seen miss these deductions, and it's a great deduction too because it's not an actual cash outlay. So it's a paper deduction that you get even if you finance a property. So you may be leveraged very heavily into these properties, but you still get that depreciation for the full amount of the entire property. And it's a great expense because it's not something you actually have to pay. It's already something that you pay for. You're paying with the mortgage already, so you do get that nice big depreciation bonus. And we see that missed a lot. That's something that we can fix these things too. It's definitely something we can go back and fix. Or there are other things like a cost segregation, and these
Mm-hmm.
type of things can go and help you make sure you get these deductions going forward. But I definitely think that that's something you should look for in your Schedule E. If you have real estate and you don't see a line item called depreciation on there and there's no expense on there, definitely talk to whoever helps pay your return. If it's TurboTax, see if you can go back and fix it. That's definitely deduction. That's a very powerful one of the most powerful ones, especially for real estate. And like I said, there's no cash outlay for it, so it's a great deduction. It can be missed, and it's definitely something you want to make sure you're getting.
Yeah, and I think this is where you mentioned TurboTax, where the having a partner like you kind of identify missed deductions, right? Because most real estate investors, unless they've been in the game for a very long time, they don't know what they don't know. And so like I'll share one example too. We bought a property a couple of years ago, and we had to replace the roof. And my CPA, hey, did you do, oh yeah, we had to replace the roof. Okay, all right, we need to get all the expenses, what you paid out, and things, materials and labor and things like that, so we can um, depreciate, the new roof, right? And if I hadn't working with someone like him, I would have just like, okay, I just paid for the roof, and that's the deduction, my cost,
Yeah,
cost of maintenance. But yeah, having someone experienced in the area to kind of maybe look at what you've done in the past, or even years before, and say, oh hey, I think we can maximize this particular expense to the fullest.
yeah, and you brought up a great point too of just thinking about it in a different way. I
Mm-hmm.
think one of the things that kind of really helps with this is getting the mindset that your real estate's a business. Making sure you're tracking everything like it's a business, making sure you're tracking those expenses. I can't tell you how many times our clients say, "Oh yeah, I remember I bought something over in June, and I it was a few $100, and I'm like, yeah, if you keep track of these during the year, that's going to be the most important thing. These deductions really add up, even little things, even little software subscriptions. All of a sudden you need to get a QuickBooks subscription, or you had to buy Excel for your rental properties to keep track of everything. These are deductions that you can take. So, keeping track of just all of these little deductions are definitely things that can help you. And, people are always concerned too, oh no, what's a deduction, what's not? And these are things that we can go over too.
Hmm.
I think that's one of the great things of having a CPA, someone like us, to kind of bounce these ideas off of, making sure that you're comfortable with your own tax return as well. I think that's another thing that we really help with. It's helping you understand your tax return, what are deductions, what aren't, or how to even make something a tax deduction. Maybe you're looking at properties out in a vacation area you like to frequent as well. You know, Seeing if there's a way that we can incorporate different type of ideas to see if you can get a tax deductible trip out there to look at the properties. And then you say, well, I just happen to be in the area. There's different methods of how we can even expense certain travel expenses. It's called the sandwich method of um, going in and planning a trip on a Friday and having to go over the weekend, and then
Mm.
having some more business on a Monday, and then that way more of your trip is deductible because most businesses aren't going to work on the weekend. So these are type of strategies that we can do to help you kind of get more expenses and just things that you might already be doing.
Yeah, one of the things my dad shared before, in passing was like, hey, buy buy property where you like to vacation,
Yeah,
and
exactly.
you got to go out there and inspect the property, and sometimes you got to stay there for a little bit. But yeah, go buy property where you like to vacation.
Yeah. And if you like to vacation there, chances are other people do too. One thing that we're seeing a lot more of these days are short-term rentals, Airbnbs.
Mm-hmm. Mm-hmm.
So that those are definitely exploding in the market right now. And so if it's a spot that you like to vacation anyway, I'm sure other people love to vacation there too. So it may be a prime stop for your real estate investment anyway. And these are all types of things where short-term rental rules for taxes are completely different than long-term rental rules.
Oh,
So these are,
okay.
yeah. So there's different strategies that we can use to help get short-term rental losses a little bit easier than these long-term rental losses. So these are the type of things that when we're talking to clients, they're like, oh wow, I didn't even know that. So, material participation rules for short-term rentals are very different than they are for long-term rentals, and what you can take and what you're able to expense and even take against W-2 income in some cases.
Hmm.
Um, so these are all really powerful expenses that we can take. And then also when you're combining it with other tax strategies like a cost segregation, these type of things can really be beneficial for our clients.
Yeah, you mentioned cost segregation. I do want to come back just a little bit, but I think a point that you kind of subtly make was, regarding how short-term rentals are different from buy and holds, regular buy and holds, and then also planning trips around investing properties. And I think it's important for real estate investors to obviously have a great CPA or tax professional behind them, but also kind of bring them in early on, right? So they can be advised. All right, I'm planning this trip. How should I structure this trip? All right, I want to buy this property, but I'm not sure if it's short-term renter or long-term renter, and help map out the direction, or options that the investor can do to really maximize the property.
Yeah, no, you hit a great point. A lot of people think of taxes as a once a year thing. I file my taxes in April or March, or I extend and I wait all the way till October, and I don't think about it any other time. I'm like, that's that's totally fine. I get it. Some people don't like taxes, and you don't want to think about it more than once a year. I get
Yeah.
it. But there are other strategies available if you do want to start maximizing these things. Talking to us throughout the year before you do something, or talking to us throughout the year and saying, is there anything else I can be doing before the end of the year? Accelerating expenses, or if I ask my contractor to fix this, I'm having a remodel done. Asking your contractors to break out items in it. So instead of just saying a remodel for $50,000, have them break out how much was flooring worth, how much were the kitchen cabinets worth. These are types of items where we can take faster depreciation and in some cases even bonus depreciation, which is basically just like expensing it. So these type of tools and tricks that we can talk about throughout the year are definitely ways that you can save on taxes and not just, a once a year phone call. You definitely want to talk to someone who's willing to get on the phone with you and strategize throughout the year. Another thing that we come across a lot too are people are selling a property and they've heard about a 1031 exchange and they're like,
Hmm.
oh, 1031 exchanges are great. I can defer all the taxes. And that's true. They are a great tool and we recommend them all the time. But sometimes you don't even need them. I
Mm.
can't tell you how many times I've gotten to a client's tax return and I'm like, you have, $400,000 of passive losses and you have a $20,000 gain on this property. You're going to be fine. If you take this gain right now, you won't even pay any tax on the gain. And they're like, oh,
Yeah.
I didn't even know that. And then they've gone through this hassle of a 1031 and there are some certain rules that you have to meet. You have to meet some time requirements, and in this
Hmm.
market, it can be very difficult to do. So, talking with us, seeing if you need a 1031, or seeing if you already have enough passive losses, or even maybe you're out of loss at the property. Even rare these days, but it does happen from time to time. So yeah, talking to us throughout the year is definitely something our clients are seeing the value in as they continue to work with us. They start talking to us more and more of like, okay, I'm
Right.
purchasing this property in a new state. Are there any implications? These type of things are definitely things throughout the year that we can talk about and we definitely help our clients with.
What do you think is kind of the sweet spot for investors? About once a quarter, twice a year, having conversations with their CPA about strategic planning.
Yeah, it's what we love to say is it's kind of however you want to talk to us.
Hmm.
You know, it's one of those things where some clients, they definitely don't want to talk to us throughout the year, and that's fine. But I'd say, at least twice a year is usually a good idea. You
Hmm.
know, or anytime you're making any major change. I think one of the ones that we see a lot too is they'll make the switch from long-term rentals to short-term rentals. That's when we're seeing a lot more of these days, and the different tax implications for both of these is definitely something you want to talk to us about. So, it's some of our clients love to talk to us throughout the year. Some of our clients, quarterly, and then some of our clients, they only talk to us when major events happen. They're getting married, they're having children, they're selling a lot of their properties just because they want to. It can get a little hectic once you start getting 20, 30 properties going. So
Hmm.
some people want to downsize or consolidate, and those are great times as well.
So you mentioned um, thinking like a business owner, really thinking, um, having at the top of your mind as you as real estate investors spend things, is this tax deductible, right? Asking that type of question on things. But I think also there's like some people are scatterbrained, and they've got the job that's really stressed out, and they got to deal with this rental property, and they got to deal. What's the obviously for you? You don't want them to show up at in December, March 14th or April 14th with a box full of receipts. So
Mm-hmm.
maybe what's some ideas that kind of alleviate their pain, right? Going going through all that stuff, and maybe being a little bit more organized. That's easier throughout the year rather than trying to figure this all out at the end.
Yeah, no, that's a great question. It's always a question too that we get to of, how should we be tracking everything? How should I be doing this throughout the year? And what we always tell people is whatever is easiest for you. There are a ton of apps out there. Stats is a great one that I know of. QuickBooks can be great as well, or even just in Excel. The most important thing is that you're keeping up to date with it on a day-to-day, week-to-week basis. You can always go back and do the receipts, but you may forget something. You may not remember what this meal was about. Was it business? Was it not? So these are type of things that you want to keep up to date during the year. Some of our even more advanced clients have just keep it in Excel, and that's fine. A lot of people are like, oh, I need to get QuickBooks or I need to get an app in order to track everything. And I'm like, well, the most important thing is keeping up to date with it. If you have QuickBooks but you don't update it, it's not as helpful as if you just had an Excel that you kept to date all year. So I think people get a little intimidated by trying to keep all of the records and all of these apps out there. Excel's great. Google Docs, whatever you're comfortable with, whatever medium you're comfortable with, just keeping track of it that way. That's the most important thing. And that's
All
also
right.
what the IRS would look for under an audit anyway. It's just how are you keeping this? And if you have an Excel, that's great. You know, receipts are you need the receipts. You definitely
Mm-hmm.
need them, but even just keeping a track of it in Excel, that's perfectly okay. People are like, oh no, all I have is an Excel. I'm like, please, that's perfect.
Yeah, and one thing I learned from a friend of mine is that how important the receipts are because IRS won't accept bank statements as your expense, right? So obviously a lot of people have cell phone cameras these days, so that is can help people track. Once you make the purchase, hey, take a picture of that, right? Um,
Yeah,
you kind of mentioned I like your thinking where it's like, hey, it's actually whatever you use. It's almost like the gym, right? You're like, what's the best gym or what's the best
exactly.
bicycle, right? It's actually the one that you use the most is the best gym or best bicycle, right? Um, and so that's fantastic. Yeah, a lot of people kind of just get hung up and what do I do with these things? And there's yeah, absolutely. There's lots of free software out there, but it really comes down to what are you using? And like I actually have a client. We were going through her stuff. She's got a handful of properties. She's very old school. Does it by hand. She's got this ledger
Perfect.
and like perfect handwriting. She had very perfect penmanship, so like you could track it all up. And it's like I was just kind of just amazed at but whatever works, and taxes are okay. So
Yeah, no, exactly. As long as you're keeping track, that's the most important thing. And it's also so you don't lose out on the deductions too. Like we mentioned earlier, forgetting halfway through the year that you've spent, even $100 here and there can make a big difference. So, making sure you're getting deductions and it adds up. You'd be surprised how much of these little expenses throughout the year really, really add up for you.
yeah, and I think I kind of just add on too about tracking is, and I think it's important for real estate investors to once they get that first property, whether it is through an LLC or sometimes they just take it under their name or their trust, is to actually open up a separate bank account for all those deposits and expenses. So it is easier too at the end of the year where you just maybe just have one debit card, one checkbook to pay out these particular expenses. So hey, everything from this account is really just is business related.
Yeah, no, that's a great tip. And, especially if you have that LLC, that's definitely something you want to be doing. You want to make sure that you're not commingling those funds together. Whenever you have a different entity, you want to try as much as you can to make sure that, you know, those things are separate from you. The LLC is a separate entity. It's a separate being, basically. It's a separate almost person. So you want to make sure that if you do have that separate entity going, you have a bank account for it and you only use business expenses out of it. But yeah, even if you don't have an LLC, it's still a great tool. Just like you mentioned, it's great to kind of ease the burden for yourself, making sure everything going in and out of it's only business, and that way it's nice and simple at the end of the year. Um, but yeah, definitely keep track of those receipts though. Still,
So obviously in this discussion we're talking about saving money on taxes, and I get this question a lot is people hold their real estate into LLCs, and they also have heard of S corporations as a good way to save money on taxes. And whether they should do the S corp election for this particular LLCs. So I wanted to ask you this question: how are you advising your clients on whether they should or should not do the S corp election for their LLC that is holding real estate and receiving real estate income?
yeah, so that's a great question, and we get that a lot too. When it comes to getting those type of entity classifications, if you're doing the traditional real estate, buy and hold short-term rentals, generally we don't like those as elections. It has a lot of additional requirements that you have to do, and it's not really going to save you anything. At the end of the day, there's a whole bunch of extra fees, and also S corps in rentals in S corp, sorry, are generally a no-no. We generally don't like to keep our rentals in S corps. There are a few different rules that kind of can make it so that if you start distributing properties out of that S corp for whatever reason, for loan purposes or for other reasons, that's where you can actually have some phantom income going in. So we really don't recommend rentals going into S corps. S corps are a great structure for active businesses, consulting firms, and doctors, lawyers, those type of things. S corps are a great tax saving strategy for active businesses. But as far as rental real estate goes, we don't want to show those in there generally. Um, LLCs are great; they're great for asset protection, but as far as tax structure goes, an LLC is the way to go. We're seeing a lot of different ideas out there these days too, and as long as we don't do that S selection, that's kind of what we want to stay away from for these rentals. Um, like I said, S corps are great. They definitely have their place. We recommend them all the time too. Just for example, our realtor clients. We have a lot of realtor clients. That's where an S election makes sense. You
Mm-hmm.
have an LLC doing that. That's where that S election will save you a ton of money in taxes, and also allow a little bit easier retirement contributions as well. That's something that a lot of our business clients don't know either. Once you start making your own business as a solopreneur, there are still retirement options out there for you that can save you on taxes and help you put money away for retirement. So the great thing about real estate is a lot of people are involved in it from all types of life. So we have experience dealing with all types of people and all types of other businesses, because a lot of people they'll have their traditional day job, their W-2 or their consulting firm or their engineering or doctor firm, and then they'll also get real estate on top of that. So we have the cool thing about that is we've talked to so many different types of people, so many different types of investors that we really have a unique understanding of a lot of different types of businesses. And I think that S selection is one of those things where it can get a little confusing. That's really where you need, a CPA's help, making sure what needs an S selection, what doesn't need that S selection, what type of entity is best for each thing. So that's a great question to just kind of. There's so many strategies that can kind of go through my head when we're talking about those type of things and making sure what's right for you in that situation.
Right. So, you talk about your experience about the wide breadth of people who are real estate investors. Now, if you can kind of narrow maybe like the top three things that all of them have that make them successful, like that you see in common across the board, what would you say those things would be?
I would definitely say just keeping at it. Keeping a good mentality about it, keeping treating it like a business. I think that's the thing that really sets our clients apart is making sure you're thinking about it like a business. You want to make money at the end of the day, but you also get these great tax advantages. So making sure we're meeting both of those, working with both us and your legal team, making sure that we're all working together to make sure we get your goal across for these rentals, or whether you're doing other things like tax deeds or tax liens. We've seen all sorts of real estate things, long-term notes, treating it like a business, having the mentality of treating it like a business. That's really where our clients who are successful. That's really where they outshine some of the other people. They're great for passive investment. Real estate's great for passive investment, but if you really want to start getting the big dividends out of it, treating it like a business and making sure you're keeping track of it. The more you do with it, the more you get out of it.
Right, right. All right, fantastic. We're here with Joseph Daron, CPA from By the Book Tax, talking about the tax deductions you can get here in 2021. So, what are some other tax deductions that real estate investors are missing this year?
Yeah, so I think we've mentioned cost seg a few times.
Oh,
Cost
yes.
segregations are a great tax savings out there. And, a few years ago, a lot of people think that cost segregations are complicated or they're too expensive or they're XYZ, there are so many problems with them. No, they're a great tax deduction in the right circumstances. You want to make sure that you talk with us to make sure if you'll actually get the most benefit out of it, but they're definitely a huge write-off. So basically what a cost segregation is, for anyone who doesn't know, is you basically hire an outside firm, an engineering firm, to come in and they'll look at your rental property and they'll say, okay, this rental property has X amount of kitchen cabinets, X amount of flooring, and X amount of this. And each one of these items is worth Y amount. Now, traditionally, when we're doing depreciation, which we also talked about earlier, we have to depreciate the entire building. So if you buy the property for $500,000, 400,000 is land, 100,000 is building. We can depreciate that $400,000, and we depreciate that over 27 and a half years. That's just kind of the rules we go. But with this cost segregation study, they'll go in and say, since X amount is flooring and Y amount is kitchen cabinets, these have a shorter depreciable life. So instead of waiting 27 and a half years to get that deduction back, you wait 5 years.
Hmm.
And right now, the really cool thing about cost segregation studies is bonus depreciation can be allowed. So not only do you, instead of getting 5 years, you get it all right away. So these are huge tax savings that people can get, and it makes a huge difference on these tax returns. Now, again, talk with us because there are passive activity rules and short-term rental rules. All of these rules, whether you're a real estate professional or not, can make a big difference. These are all types of things that can really affect when a cost segregation makes sense. So it's definitely something you'll want to talk to us or your CPA about. before you do it. Um, every once in a while, we'll see someone who does a cost segregation and they can't take the full benefit from it in the current year because they have these passive activities. So definitely talk to your CPA about it, and or feel free to give us a call, and I can definitely help you see if it's the right thing and see if it's the right time too. Timing for it can be very important. I think one thing I do want to caution with cost segs is what some people don't really remember is that since you're taking all that depreciation right away, in future years that depreciation will be a little less.
Hmm.
So so a lot of people will get that first year deduction, and then if they don't do another cost segment, they're not getting more properties. They may not have as much depreciation next year and may have a little more income than they were expecting. So making sure that you know all the pros and cons with cost segs is important, and making sure that they're actually going to benefit you is also very important. These are all things that we help our clients with, and your CPA should be able to help you with.
Right. Yeah. And this is not necessarily limited because I know these are popular with commercial properties, but you can do this on single family rentals, multi-unit rentals, right?
Yeah, exactly. So that's the thing too. Whenever in the when I was going to school, cost segregation studies were more for these big commercial properties, but in recent years, they've been more available for single-family homes, duplexes, um, all sizes, and we have firms that we also refer out to. So we can give you, if you're looking for names, we definitely have some names out there that we can refer out to. Make sure you're getting treated right and you're getting a professional report done.
Cool. Yeah. So there's lots of good stuff here on saving your taxes in the real as a real estate investor. Is there any other cool stuff that you can share with us that real estate investors are maybe missing?
Yeah, the other one that we always get asked about are 1031 exchanges. Those are always the other thing that we always get taught, we always are hearing about, and clients are always asking about. And so a 1031 exchange is, in the most basic sense, is you're buying one property and you want to move up to another property. That's traditionally how it's done. And that way you can sell this property, and even if it's at a gain, you can defer that gain into the next property. So you're not paying any taxes on it yet. And you basically defer it, and then as long as you don't sell that other property, you don't pay the tax on it. So, when some of our clients who have had properties for years and years and years, and they've appreciated and appreciated and appreciated, and they maybe want to get out of that single family home and they now want to buy a fourplex or something, it's a great time for a 1031 exchange, because all that appreciation in there, you may be thinking you have a big tax bill, but with that 1031, you're not going to owe it. It's going to go straight into that next property, and that way it just sits there. So
So kind
1031
of a
exchanges are great.
a specific question. What if um, this the after the sale of the existing property, you're buying a replacement property for less than what you sold the last property for, and you got a cash. So, like, how does that impact the seller in terms of taxes?
Yeah, those are situations where you definitely want to talk to us beforehand, because that's situations where a 1031 exchange doesn't make sense. You may not, you're probably going to owe some money and some tax on there. There are implications of 1031 exchanges, so you definitely want to talk to someone who's knowledgeable about them. Um, you don't want to buy down usually. That's
Hmm.
usually a no-no. It can cause tax implications and where you owe, and it just depends on the numbers and how they kind of flush out. So definitely something you want. That's a great example of when you really want to reach out to your CPA and someone who has knowledge of them. Another thing that people may not know about 1031s is you can buy, you can do multiple properties doing it. So
Hmm.
maybe you have one property that's worth a lot of money, but you want to buy two duplexes instead. You can do a 1-to-2 1031 exchange, and that's totally allowed. So the ideas with 1031 exchanges, there's a lot of stuff out there, and there's a lot of opportunities out there for tax savings and for just investing in general. So a great opportunity, if this is something you're thinking about, getting rid of a property, a great opportunity to kind of reach out to a CPA.
Yeah, yeah. I've obviously I've studied 1031s, and it's a good way to really kick the can on those capital gains taxes that you'll have to pay. But it doesn't sound like eventually you got to pay the Pied Piper, right? And
Yeah.
sounds like that particular part of the equation has not been figured out yet. But at least it can be kick the can down the road.
Yeah, the joke is 1031 till you die. It's a little morbid, but yeah, that's the best tax strategy out there would be 1031 till you die. Little morbid, but that's once you start getting to a state and stuff, the law gets a little bit different. So Yeah.
Right, right. Oh man, this is awesome, awesome stuff here. We're talking about cost segregation, 1031 exchanges, really changing your mindset about being a business owner and a real estate investor. And I'm sure you've got some more stuff with us, right?
Oh, I could go on and on and on. Yeah, no, the sky's the limit with these tax strategies. Home office deductions are another thing that people can take as well, even on this real estate. Auto deductions, all that driving that you have to do to go out and see these properties, traveling, continuing education. All these are expenses that we can, help you incorporate on your tax return, making sure that you're getting all these, and whether you're just shielding rental income or whether you're able to take it against your W-2. The other thing that we always get asked about is real estate professional. And I could go on, and that's its own entire show of real estate professional and all the rules with that. And great tax deductions there as well, but a lot of rules that you kind of have to follow. So definitely a time to reach out to a CPA or someone who's really knowledgeable about it.
Speaking of tax, real estate professional, and going back to the S corp election,
Of
would
course.
you also say people, investors who are flipping as opposed to buying and hold, may be able to take advantage of the S corp election?
Great topic. Yeah, of course. And that's where all of this real estate can get a little confusing. Flipping is considered an active business, so that is a Schedule C. So that's where an S corp would make more sense. So yeah, that's a great point there, and that's another reason why all of this can get a little confusing. Not all properties, not all people will be um, pigeonholed into a traditional LLC. Some people, an S corp makes more sense, and that's really where a CPA and people like us in our company can definitely help you navigate all of these tax laws, all of these tax rules. They can be a little overwhelming at first, but we definitely try and make sure that it's understandable for you, and also make sure that you're making the right decisions. And like you said earlier, doing it from the start is a lot easier than trying to do backtracking. We know how to fix things. We can fix things. If you've ever messed something up, it's not the end of the world, but it is easier to do it right the first time.
Absolutely, do it. There's a saying, for us, we take the bar exam, and now it's only 2 days. Back then when I took it, it was 3 days, and there's a test prep company out there. Their slogan was, "Do it once, do it right, never do it again." Yeah, but
Yeah,
I
yeah.
don't. Yeah, I think. Well, I props to the CPA, man. I know you got to put in all those hours, and then you got to take like 4 exams, right? So yeah, I don't envy that at all. But I think that's where the profession is kind of better as opposed to the legal in terms of education, because doctors that got their residency, CPAs, you got to put your hours in. Lawyers, technically you don't even have to go to law school. Kim Kardashian is not going to law school, and she can just take the test, and if she passes it, technically she's a lawyer. But hey, we're having a great conversation here with Joseph Daron, CPA, and I want to, before we kind of get to the end here, I wanted to circle back on a kind of an email conversation we had a while back about um, asset protection and structuring from the accounting point of view. And so um, for us as attorneys, right? Like we can set up these all crazy elaborate structures, and I tell my clients we can do that. The only thing is anybody with enough money, enough time can penetrate through any shenanigan you want. So it's really a balance of what you can maintain, and in terms of costs, and what you're willing to do it. And really, the idea of asset protection is really just to make it hard for people to go after you. Okay, not impossible,
Hmm.
but hard. um but I can't, we had this conversation, and you made a really good point on what clients actually do when there's multi-tiered structures, and how that can really affect them. So I wanted to kind of bring that around to the front again, and ask you from the accounting point of view how you've seen clients, you know, uh, do things good or mostly not do the right things, and then how it actually can affect their asset protection liability.
Yeah, I think that's a great point. I think a lot of people are like, oh, I want all of these entities to help protect me. And I'm like, okay, well, if you have a tiered structure where, one LLC owns another LLC, and then that LLC owns a property and maybe one other one, you have to flow the money through correctly. The bookkeeping for that can be very intimidating and very intense. And we've seen even advanced clients get kind of caught up in that and trying to keep track of all of these entity tiers all the way up and flowing the money from one entity to another entity and then finally back to your bank account and vice versa, it can be very complicated. And these are things that you definitely want to follow if you're trying to get, if you really want this entity protection. You don't want to be commingling these funds, and you want to follow the entity structure. So make sure you get an entity structure that you can deal with. You know, you're the asset protection guy, but I've always thought, and you can always correct me if I'm wrong, but making sure you're keeping that entity separate from yourself is very, very important. And that can sometimes be more important than having a whole bunch of entities that you don't follow at all. If you're not following them whatsoever, maybe it'll intimidate someone from getting to you, but once they actually get there, now you're in trouble. So yeah,
Yeah.
just making sure you can follow it, and there's always fees associated with it too. Make sure you know kind of what you're getting into. There's state filing fees for a lot. If you're in California and you have an LLC, you're going to owe $800 a year. That's California, and that's the FTB stance.
Yeah.
Now, there's a lot of people saying that maybe they don't do this, and this is something that's still being litigated in the courts. So, but right now the FTB stance is pretty much if you own an LLC and you live in California, you owe $800 a year and the tax return to them too. So
Yeah. I
just
call that the
be
sunshine
aware.
tax.
Yeah,
Like
exactly. That's the yeah,
the privilege of doing business in California. Yeah, absolutely. Like, yeah, I've had that conversation. Like, how to kind of voice like, if you're in California, there's no way around this tax. So just think about how to make $800 and stop trying to figure out how to get around this tax, because you've probably spent more than $800 trying to figure this out, where you could
yeah.
just making that money. So, hey, thank you, Joseph, once again for joining us. And yeah, we're at 40 minutes now. We could probably spend a couple days just talking about these, these tax strategies.
Oh, I
So,
got plenty. We haven't even delved into real estate professionals, so
okay, maybe we'll do a part two, and
that
that
sounds
could be
great.
for the professionals. Um, but here towards the end here, this is the intentional entrepreneur, and of course you have your own shop you own with your wife, enrolled agent as well. So they talk
Yes.
taxes all day long. They must love it. But we're gonna go through the rapid fire question as through your entrepreneurship journey, and share a little bit about how you guys got to where you are. All right, so you ready?
Yeah.
Okay, so who do you look up to?
My father.
All right. What's the best business advice you've ever received?
Uh, Measure twice, cut once. Always make sure before you execute something.
Measure twice, cut once. That's very good. Um, what's the best business book you've ever read?
The book on advanced tax strategies by Amanda Hahn and Matt McFarland.
Hmm.
It's a great kind of intro to taxes.
I kind of a side note. I recently read. I can't remember the title, but it's by Tom Wheelwright, who
Uh huh.
is on Robert Kiyosaki's team for real estate. But I found it very, very good and eye opening. So the next question is, if you could do one thing over again, what would it be?
Start my business way before the pandemic started.
If we all had the crystal ball.
Yeah.
All right. And what's the biggest challenge in your business today?
We're growing really fast, so I think we're going to actually hit capacity this year. So it's going to be saying no to clients eventually.
Wow, congratulations.
Yeah.
And then the final question is, have you heard the term 3 feet from gold?
I have not.
Okay. So kind of broadly speaking, how would you know when to pivot your business or to keep going in the direction you're going?
Yeah, I would definitely say if you see continued growth and continued success, that's definitely the way to keep going. If you start seeing that growth starting to, you're not seeing new clients, you're not seeing the market kind of doing what you want it to do, might be time to pivot.
All right. We're closing it out with Joseph Daron, CPA from Buy the Book Tax. And, if we want to reach out to you, where can we find you?
Yeah, our site is the best way to reach us. It's buythebooktax.com. And we have a contact link on there. You can learn more about us, kind of our pricing and everything that we have on there. And please feel free to reach out. We're still available. We still have room, but definitely want to reach out soon.
Yep, get in before they start turning clients away, and I'll put the links in the show notes so our listeners can reach out to you guys directly. Hey, Joseph, thank you so much again for joining us today, right before you guys get all crazy with the tax season, and hopefully we can talk again soon.
All right, sounds great. Thank you so much, Dan.
All right.